Two Australians make the exact same decision on the exact same day. They both spent years saving. They both sacrificed holidays, skipped weekends away, and watched every dollar. Now standing at the same financial crossroad with $50,000 in the bank, they each believe they're about to make the smartest investment of their lives. One signs the paperwork on an investment property. The other opens an app, buys a handful of boring index funds, and closes his laptop. Ask almost anyone which person looks wealthier that afternoon, and the answer is obvious. One owns bricks and mortar, the other owns a number on a screen. One gets congratulations, the other barely gets a reaction. But 20 years later, something strange happens. Strip away the emotion, the dinner party conversations, and the decades of repeated financial advice, and the gap between them isn't nearly as wide as most Australians imagine. Sometimes it disappears entirely, which raises an uncomfortable question. If property really is Australia's greatest wealth-building machine, why do so many investors quietly sell after only a few years? And if the market is supposedly easier, why do so many people abandon it the moment headlines turn red? The answer has very little to do with money. It has everything to do with how human beings measure success. Because Australians aren't comparing two investments, they're comparing two completely different lifestyles. So forget what your parents told you. Forget the property seminars, finance influencers, and headlines that insisting there's only one path to wealth. Instead, let's follow two ordinary Australians over the next 20 years. Same income, same savings, same starting line. One chooses investment property, the other chooses low-cost index funds. No perfect timing, no one in a generation luck, just two decisions and the full cost of both. Because once you include everything, not just returns, but the time, stress, risk, and opportunities that quietly disappear, you may realize the investment everyone calls safe isn't the one carrying the greatest hidden cost. Meet Liam. He's 28, works full-time in Melbourne, and has spent years hearing the same advice. Get into the property market as soon as you can. So when he finally saves $50,000, he buys a modest investment property in a growing regional suburb. The bank approves his loan. The tenant moves in. For the first time, someone else is helping pay off an asset he owns. It feels like financial adulthood. Across town, Ethan makes a decision barely anyone notices. Same age, same salary, same savings. Instead of inspecting houses, he invests the same $50,000 into a diversified portfolio of Australian and international index funds. No keys, no congratulatory phone calls, just a confirmation email saying his order has been filled. At the first glance, Liam seems to be winning. Property feels real. You can see it, touch it, drive past it. Shares don't offer that. Psychologists call this a tangibility bias. We naturally trust what we can point at more than what quietly compounds in the background. And that simple psychological difference is where their 20-year story truly begins. For the first year, Liam can't stop checking property websites. Every hire sale nearby feels like another win. Every rent payment feels like proof that investment is working. It almost feels like passive income. Almost. Because before the rent becomes profit, it has to survive the mortgage. Then council rates, landlord insurance, water charges, property management fees, maintenance, compliance checks, smoke alarm servicing, emergency plumbing, electrical faults, the occasional broken appliance. None of these costs arrive together. They appear quietly, one at a time, each manageable on its own, until you look back over the entire year. 1 month, the hot water system fails. A few months later, heavy rain reveals a roof leak. Then the property sits vacant between tenants. Every day, it's empty. The mortgage still arrives. Insurance still arrives. Council rates don't pause because nobody's living there. The property keeps costing money, whether it's earning any or not. Suddenly, the investment that was supposed to pay for itself starts asking for Liam's own salary to keep it alive. That's the part almost nobody posts about. Because gross rent makes a great headline. Net profit tells a very different story. Yet, despite all these expenses, Liam isn't necessarily making a bad investment. Every mortgage repayment slowly reduces his loan. If property value rises, so does his equity. He's using a relatively small deposit to control an asset worth several times more. That's leverage. And it's one of the biggest reasons property has created wealth for so many Australians. But leverage has a twin brother and rarely gets mentioned: risk. Higher interest rates, unexpected repairs, or long vacancies can quickly turn positive cash flow into a negative cash flow. Owning an investment property isn't simply owning an asset, it's running a small business. One with customers, operating costs, regulations, emergencies, and constant decisions. Some investors thrive on that responsibility. Others realize they've accidentally bought themselves a second job. Meanwhile, Ethan's investment looks almost laughably boring. No tenants, no maintenance, no phone calls, no weekend inspections. Months pass where almost nothing seems to happen, and strangely, that's exactly what makes it difficult to trust. Every fortnight, another automatic investment quietly leaves his bank account. Some months, the portfolio rises. Other months, it falls. Occasionally, it seems to go backwards for no reason at all. Compared to Liam's property, it almost looks broken because humans naturally associate actions with progress. With property, you renovate, negotiate rent, or improve the house. With an index fund, you do almost nothing. And that's precisely why so many investors never experience its greatest advantage. They interrupt it. Markets surge, they stall, they fall. Headlines scream about crashes, recessions, and panic. Friends stop talking about investing. Social media fills with red portfolios. For the first time, Ethan wonders if everyone else was right. Maybe property really was the safer option. But while property hides most of its price swings, the share market shows every one of them in real time. The greatest danger in index investing isn't the market itself. It's human behavior during market crashes, because compounding only rewards the people who stay invested long enough to experience it. Imagine two investors. Both start with good investments. One leaves them alone for 20 years. The other constantly switches strategies, chases headlines, and panics whenever fear peaks. They owned different assets, but the real difference wasn't the property versus shares. It was consistency. By now, Liam has built substantial equity. His property has likely appreciated, his loan has fallen, and leverage has worked in his favor. But every gain came with responsibility. Insurance renewals, interest rate reviews, maintenance, tenant applications, unexpected repairs. His investment rewarded involvement. Ethan's journey looked completely different. His portfolio quietly compounded in the background. No tenants, no maintenance, no urgent phone calls. Just automatic investments and the discipline to ignore every crash, correction, and frightening headlines along the way. Neither part was effortless, neither guaranteed success. They simply charged different prices. Property asked for time. Shares asked for patience, and that's the lessons most Australians miss. We spend years arguing about which investment delivers the highest return: property or shares, bricks or business, leverage or compounding. But investments don't just produce returns, they produce lifestyles. One demands your attention, the other demands emotional resilience. The real question was never which asset class is objectively better. It was always this: which investment gives you the highest chance of staying invested for the next 20 years? Because wealth has never been built by finding the perfect investment. It's built by sticking with a good one. The automatic investment made every fortnight, the mortgage payment made every month, the years when nothing exciting seemed to happen. That's where the wealth is actually created. So if someone tells you property always beats shares, or shares always beat property, they're probably answering the wrong question. The greatest advantage isn't leverage, it's compounding, it's consistency. Because where everyone else spends decades searching for the perfect investment, the people who quietly build lasting wealth simply give a good decision enough time to become an extraordinary one.